Cryptocurrency, or crypto, for short, is a digital form of money and assets built using cryptography and decentralized networks. And to truly understand what crypto is, you need to explore its origins, technology, purpose, and the massive shift it represents in how humans store, transfer, and control value in the digital age, because crypto is not only about coins or trading but about rewriting the rules of money, ownership, and the internet itself. The story begins long before Bitcoin, when computer scientists tried for decades to create digital money that couldn't be forged or copied, but every attempt failed due to the double spend problem, meaning digital files can be duplicated endlessly, making them impossible to use as money without a central authority keeping track. But this changed in 2008 when an unknown person or group named Satoshi Nakamoto introduced Bitcoin and the blockchain, a breakthrough that finally allowed digital money to function without banks or governments, because the blockchain acts like a public, unchangeable ledger distributed across thousands of computers, making it impossible for any single authority to alter records, cheat the system, or shut it down. This decentralized design became the foundation of all cryptocurrencies, not just Bitcoin, and it introduced a new model where trust is replaced by mathematics and code, meaning you don't have to trust a bank to hold your funds. Your wallet and private keys give you full control, and no one can freeze your account, reverse your transactions, or change monetary policy. And while Bitcoin was the first cryptocurrency focused on peer-to-peer digital money, the crypto world expanded rapidly with the creation of new blockchains like Ethereum, which introduced smart contracts, self-executing programs that run on the blockchain without needing intermediaries, enabling developers to build decentralized applications (DApps) for finance, gaming, identity, supply chains, marketplaces, and much more. And this innovation opened the door to Web3, a movement aimed at rebuilding the internet so users own their data, assets, and identities instead of corporations controlling everything. But before exploring these advanced concepts, it's important to understand the basic categories of crypto assets, such as cryptocurrencies like Bitcoin and Litecoin used for storing and transferring value, utility tokens like UNI or BNB that grant access to network features, governance tokens like COMP or AAVE that let holders vote on project decisions, stablecoins like USDT or USDC designed to maintain a fixed price by being backed by assets, and non-fungible tokens NFTs which represent unique digital items such as artwork, tickets, gaming assets, music rights, domain names, and collectibles, all of which can be owned and traded digitally because they are verified on the blockchain. But crypto is not just technology, it is also a global financial revolution, especially in countries where banking systems are weak, currencies are unstable, or people are excluded from traditional finance, because crypto wallets allow anyone with a smartphone to store money securely, send payments internationally in minutes, access online financial services, and protect their savings from inflation, giving millions of people financial freedom and inclusion they never had before. And one of the biggest innovations born from crypto is decentralized finance DeFi, a system where financial services, like lending, borrowing, trading, saving, and earning interest, are powered by smart contracts instead of banks, meaning these services are open 24/7, available worldwide, transparent, and controlled by code rather than human decisions, allowing users to earn yield on their assets through staking, liquidity, provision, and decentralized exchanges, which created a completely new digital economy. Meanwhile, crypto networks stay secure through two major methods: mining, proof of work, used by Bitcoin, where powerful computers solve puzzles to validate transactions and earn rewards, and staking, proof of stake, used by networks like Ethereum after 2022, where users lock their coins to support the network and earn rewards in return. And both systems create strong economic incentives for people to maintain the blockchain's security and reliability. As crypto grew, major companies like Tesla, PayPal, Visa, MasterCard, and many banks began exploring blockchain technology, some accepting crypto payments, others building blockchain tools, and even governments started responding. Some countries created regulations to control crypto, while others embraced it to encourage innovation, and in the case of El Salvador, Bitcoin was adopted as legal tender to increase financial inclusion and modernize the economy. However, the expansion of crypto also brought challenges such as price volatility, scams, lack of user education, regulatory uncertainty, and security risks for people who don't understand how to protect their wallets. Yet despite these problems, the crypto world continues to grow because it represents a more open, transparent, and user-controlled model of digital finance compared to traditional systems. And what makes crypto truly powerful is the idea of self-custody, meaning when you hold your private keys, you own your assets directly without needing permission from anyone. which gives individuals more freedom but also more responsibility. And while some critics argue that crypto is only for speculation, the reality is that its underlying technologies, like blockchain, decentralization, smart contracts, and tokenization, are reshaping industries far beyond money, including logistics, healthcare, gaming, art, energy, governance, and identity systems, showing that crypto is not a trend but a long-term technological shift. Cryptocurrency did not become popular overnight. Its rise happened because people around the world were unhappy with the traditional financial system and were looking for a better, more transparent, and more fair alternative. Many people felt that banks had too much control, governments printed too much money, and ordinary people paid the price whenever there was an economic crisis. Bitcoin arrived in 2009, right after the global financial crisis of 2008, and it introduced a system that didn't rely on banks, didn't require trust in institutions, and operated with clear rules written in code. As more people learned about this new idea, they began to appreciate the possibility of a world where money was not controlled by a small group but instead by a network of users worldwide. This philosophical idea gave crypto power and attracted millions who believed in financial freedom, privacy, and decentralization. Over time, cryptocurrencies expanded beyond philosophy into real-world applications, creating an entirely new digital economy that touched finance, art, gaming, and global payments. One of the most important concepts in cryptocurrency is the idea of wallets. A crypto wallet doesn't store your coins physically, instead, it stores your private keys, secret codes that prove ownership of your digital money. There are different types of wallets, each offering different levels of convenience and security. Hot wallets are connected to the internet, making them easy to use and perfect for beginners, but they are also more vulnerable to hacking. Cold wallets, like hardware devices or even paper wallets, stay offline and offer the highest level of security but require careful handling. Wallets are a crucial part of the crypto world, because they allow people to store their money independently without relying on banks or third parties. This system of self-custody is powerful but also challenging. Users must learn responsibility, because forgetting a password or losing a private key can mean losing access to funds forever. Nevertheless, wallets represent one of the clearest examples of how crypto gives users full control over their financial assets. Another major development in the crypto world came with the introduction of Ethereum in 2015. Ethereum expanded the idea of cryptocurrency from digital money to a platform for decentralized applications. What made Ethereum special was its invention of smart contracts, self-executing programs that run exactly as written without the need for a middleman. A smart contract can manage money, create agreements, automate financial systems, and build entire digital economies. For example, a smart contract can automatically send payment to someone when conditions are met, without needing a bank or company to verify the transaction. This innovation opened the door to decentralized finance, DeFi, decentralized exchanges, DEXs, lending platforms, automated market makers, prediction markets, and thousands of new opportunities. Ethereum showed the world that blockchain technology was not just about money, it could become the foundation for a new internet where users have control instead of big corporations. Decentralized finance, DeFi, is one of the most revolutionary parts of the crypto ecosystem. In traditional finance, almost everything depends on banks, brokers, and central institutions. But in DeFi, people use smart contracts to lend money, borrow against their crypto, earn interest, trade tokens, or provide liquidity, all without paperwork, approvals, or a bank's permission. Anyone with an internet connection can participate, making DeFi especially valuable in countries where people are underbanked or face strict financial controls. DeFi platforms operate 24/7, and users maintain full ownership of their assets at all times. However, the system is not perfect. Bugs in smart contracts, hacking risks, and inexperienced users can lead to losses. Still, the rapid growth of DeFi proved that people were eager for a financial system that offered transparency, speed, fairness, and global access. Billions of dollars flow through DeFi platforms daily, showing how big this new digital financial world has become. Another major area that helped crypto explode in popularity is NFTs, non-fungible tokens. While cryptocurrencies like Bitcoin and Ethereum are fungible, meaning each unit is identical, NFTs are unique digital assets stored on the blockchain. They can represent anything: art, music, videos, game items, collectibles, identities, land in virtual worlds, and much more. NFTs became extremely popular around 2021 when artists, creators, and brands realized they could sell their digital work directly to fans without relying on galleries or middlemen. Gamers also benefited because NFTs allowed true ownership of digital items, something that traditional games never offered. NFT technology is still evolving, and while the hype around million-dollar artwork has calmed down, the underlying idea of digital ownership remains powerful and continues to shape online economies. Stablecoins are another important category of cryptocurrency. Most cryptocurrencies are volatile, meaning their prices rise and fall quickly. Stablecoins solve this problem by tying their value to stable assets like the US dollar. Popular stablecoins such as USDT, USDC, and BUSD allow people to hold digital money without worrying about big price changes. They make trading smoother, allow easy cross-border transfers, and have become essential in DeFi for lending, borrowing, and earning interest. Stablecoins bring the advantages of crypto: speed, low fees, global access, while maintaining the stability of traditional currency. However, regulatory authorities pay close attention to stablecoins because they resemble digital versions of fiat money and could impact national monetary systems if not properly managed. As cryptocurrencies grew, so did the need for exchanges, platforms where people buy, sell, and trade cryptocurrencies. There are two main types: centralized exchanges (CEXs) like Binance and Coinbase, and decentralized exchanges (DEXs) like Uniswap and PancakeSwap. Centralized exchanges are easy to use and perfect for beginners, offering simple interfaces, customer support, and high liquidity. But because they hold user funds, they require trust, and there have been cases where exchanges were hacked or mismanaged. Decentralized exchanges solve this by allowing users to trade directly from their own wallets using smart contracts. They offer complete control and privacy but can be more complicated for beginners. Both types of exchanges play a crucial role in the crypto ecosystem, and millions of people use them daily to buy new coins, trade markets, or invest long-term. Cryptocurrency also plays a major role in cross-border payments and remittances. Traditional international transfers can take days and cost high fees, especially for people sending money to families in developing countries. Crypto makes these transfers faster, cheaper, and more accessible. Many people use Bitcoin, Litecoin, or stablecoins to send money abroad within minutes. This use case alone has helped millions of families keep more of their money and avoid expensive banking fees. In countries with high inflation like Venezuela, Turkey, and Argentina, crypto has become a tool for survival, helping people protect their savings from losing value. This real-world utility shows that cryptocurrency is not just a digital trend, it's a lifeline in many parts of the world where financial instability is common. One of the biggest challenges facing the crypto industry today is regulation. Governments around the world are trying to understand how to regulate cryptocurrencies without stopping innovation. Some countries embrace crypto and treat it as a legal asset, while others place strict bans or heavy controls. Regulators aim to protect users from scams, ensure tax compliance, and prevent illegal activities, but unclear rules sometimes create fear and uncertainty. The crypto community believes that well-balanced regulation can help the industry grow by giving more trust and safety to everyday users. Many major financial institutions, including banks, hedge funds, and corporations, have already started investing in crypto or using blockchain technology to upgrade their systems. This shows that crypto is gradually moving from a niche technology to a mainstream financial tool. The future of cryptocurrency is filled with possibilities. New technologies like Layer 2 scaling solutions, cross-chain bridges, decentralized identities, AI integrations, and advanced smart contract platforms are making crypto faster, cheaper, and more powerful. More countries are exploring central bank digital currencies, CBDCs, which are government versions of digital money built on blockchain-like technology. While CBDCs are not decentralized like Bitcoin, their development shows that blockchain ideas are influencing global finance at the highest levels. As more people gain internet access and digital education spreads, cryptocurrency adoption is likely to grow even faster. Even if prices go up and down, the core technology continues to advance, and its impact on money, finance, and the internet becomes stronger each year.